Hi, this is Pete Thompson with theptmortgage.com and welcome to the Video Homebuyer's Guide. We're talking about what is involved in qualifying for a mortgage, and today we're going to talk about one of the main three components, and that's your income. And when we talk about income, we're actually looking at two separate things. First of all, we're talking about the stability of the income, or how long do we expect this income to continue, and is it stable is what we're really trying to decide. And the other thing we're looking at is affordability, or how does this payment, the mortgage payment work? Is it going to be affordable based on your income? And with this, we look at ratios. So let's start with the stability of the income. What we're basically trying to do here is get a history of what you've done, and that means like how long have you been at your job, how long have you been in your line of work, how likely is this income to continue. And with this, we're putting a lot more emphasis on your current income than what your past income is. But we still want to know that there is a history of you're making these payments, or I'm sorry, of getting this income in, and that this income is likely to continue. And we look at this in different ways. It's easy if somebody is on a salaried position. If you're hourly and you have consistent hours, that part's easier too. If you're hourly and something like you're in the trades and your hours may go up and down depending upon the season, we're going to have to look more at what the history has been in the past too. If you're on a salary and we know what your salary is and we got a guarantee of the salary going forward, that's all we need to know. If you're in a situation where you have more varying income, and that could be somebody who's on sales with commission, could be if you're self-employed, we need to dig a little bit deeper. And, so it's like there's not a one-size-fits-all solution as far as what we look at when we're considering somebody's income. But that's part of the mortgage process, is we have to make sure we get your full situation so we can show that we have enough income to qualify for the loan. I'm talking by job income, but there are other ways that you can qualify. I mean, other income that is acceptable, and that would include like child support or alimony or maintenance, pension income, disability income, different things like that. It's again, what we need to see when we look at these sources of income is, are they likely to continue? Again, the other question we're looking at when we talk about income is affordability. And with affordability, what we're trying to say is, how much is this payment compared to the amount of income that you're bringing in, and how does that reflect with the housing payment plus all the other debt that you have? When we look at this, we look at ratios, and you've probably heard people talk about front end and back end, or housing and debt ratios. These are kind of shorthand ways that we look to see if this is going to be a home that you can comfortably afford, if you're going to be able to make the payments. And when we look at the housing ratio, what we're looking at is how much is the mortgage payment going to be? And then in addition to the mortgage payment, we're also looking at the taxes divided by the monthly amount, the insurance. If there's going to be mortgage insurance, we look at that. If it's going to be a condo or townhouse, we're also going to count the association fees in there also. So we need to see, first of all, how much is the total payment, and we're going to divide that into your income, and that gives us what's called the front end or housing ratio. And that number can change. I mean, it used to be that it was like 28% of your income could comfortably go towards the housing. Since we've been doing these automated approvals, that number has gone up quite a bit. And it really depends upon the rest of your situation. And a lot of times there's compensating factors, but either way, you need to do your own budget and make sure that this is something that's comfortable for you, whether you can be approved for the mortgage or not. The other ratio we look at is the total debt, or the back end ratio. And with that, we take the entire housing payment, again, including taxes, insurance, everything else, And then we add all your monthly debts to that amount, and that's going to give us the total amount of debt that goes out every month. And that's going to include credit card balances, student loans, if you have car payments, if you have alimony or child support, anything like that is included into this total debt ratio. We don't include things like insurance or utility payments, things that you're still going to have to pay, but we don't count those as ongoing debts against the income. So when you're looking to buy, we can go up higher, again, depending upon what type of loan you're looking at, and based on the other factors of other factors of your personal situation. But you really want to make sure that however it is, that you know what the total debt is going to go out of your pocket, and you feel comfortable with that and you're able to budget for it. So that's kind of how we look at income. Again, if you're going to be in a situation where you're looking to buy a home, you want to make sure that we look at the income the same way that you do. And sometimes you're kind of looking at saying, well, this I've got allowed for, this is covered another way. But we need to make sure that it fits into the box that we have to go by in order to get approved for the mortgage. So if there's any way we can help, please give us a call. Again, this is Pete Thompson with ptmortgage.com. Stop by our blog, and we've got all sorts of information about buying a home, getting a mortgage, and a way that's going to meet your needs. And thanks for stopping by the Video Home Buyer's Guide, and you can count on us to get the job done right. Thank you.